the cloud. Perfect. Thank you so much, Patricia. Let me share my screen because I put a presentation together, as well with Jonathan, that is a district manager at our firm as well. He will introduce himself, but so for myself, Sebastian Gilles. So I've been in the US for about 4 years. I'm from the promotion 2016. So I started my career in consulting in Paris, worked in Switzerland as well, and really enjoying being in Florida now. So I used to live in Miami. I just moved to Tampa, and I've been with Florida Financial for about a year. So really excited to show you that today. Thank you, Patricia, for the opportunity. Jonathan, if you want to say a quick word about yourself as well.
Yeah, so nice to meet you all. Like Sebastian said, we work on the same team. Here, I'm a district manager at our firm. So when Sebastian mentioned that there was some strategies to share with you all, I was happy to come on board. So I know he was going to kick this off. I've lived in Florida for quite a few years now, from the US originally. So I'm just really excited to share some of this with you, and I'll be picking it up later on. We talk about some specifics, and we'll have a Q&A at the end, and both of us can ask specific questions. We're happy to answer the resource.
Perfect. So just to start, I guess more people will join later, but we figured that as an agenda for today. So giving you some quick information about what we do at FFA, how we help folks around multiple aspects, and then taking like a deeper dive into financial planning and mostly like tax planning strategies as well. Retirement planning a little bit touching upon, and most importantly, investment strategies. A lot of things are happening on the US market so far this year. So giving you more information about how we proceed in terms of investments and how we think in terms of strategy. And as Jonathan said, so Q&A session to answer any of your questions. So, or you can drop them in the chat as well. We'll answer those. So just to give you more information about Florida Financial. So with Jonathan, we're based in Tampa. This is our headquarters, but we have multiple offices all over the US. So we typically work with folks just like yourself in the US around their professional careers, and most importantly, helping maximizing the benefits. So typically, if you have 401ks or retirement accounts, we help maximizing those plans, as well as different investments that you have on the side, mitigating the risk within this account. And what really makes us unique is that we are comprehensive. So that means that we help not only with just the finances, but also looking at the current situation. So for example, if you have kids, how do we send for college, for example? How are we looking for to pass on the assets that we have once we go in retirement, life insurance policies as well. Planning for retirement is also a big aspect of what we do. And of course, from a financial standpoint, looking at maximizing the returns for your investment. So there's a lot of opportunities there, but Jonathan will touch upon that. In terms of our process, so typically we start with a quick introductory meeting when we meet new people, because we're goals oriented. So we like to know the short-term goals, the long-term goals that people have. Typically, that can be maximizing the investment, saving on taxes, planning for retirement, sending the kids to college. Once we know around these goals, what we do is to meet during a second meeting as well to talk about the strategy. So we like to think ourselves as financial planners, as also like GPS. So we like to draw different roads that you can take to achieve those goals. It's our role as fiduciary to show you the different roads that you can take. And of course, it leads us to investments in order to achieve those goals. I want to retire early, for example. I want to plan for my kids. How do we maximize the investments that we have today? And which investments will best suit my needs? that's basically all in terms of the presentation about the firm. But if you have any other questions, just feel free to drop it in the chat. In terms, the first aspect I wanted to touch upon was tax strategies, but it's more a generic overview conversation about, most importantly, how we can save in the US and how we can invest from a tax standpoint. So this is a tax triangle. It illustrates basically how we can invest in the US and how we can diversify the taxes that we're paying, whether it's now or in retirement. So there's three main ways that we can invest in three different buckets. That's why it's called a triangle. The first one is the pre-tax tax later. So it's typically if you're contributing pre-tax to the 401k, or that's also Social Security you will get from the US government, or if you open a traditional IRA. So how does it work? It works by you putting your income, so pre-tax, you're going to pay tax after you contribute to this bucket, and the money will grow and you will pay tax later. So that means at the exit, so typically on the 401k, when you start taking out the money, or for Social Security, for example, when you're taking it out, and you're going to be taxed at ordinary income. So depending on your tax bracket, you're going to be taxed in different ways. If I'm going too fast, feel free to drop something in the chat. But that's for the first bucket. The second one is the after-tax tax always. So instead of contributing pre-tax, we already pay taxes on our income that we receive, and then we contribute to this account. So this is typically like a checking account, a savings account, CDs, or brokerage account that you can have. And this bucket is tax always. It's called tax always, simply because we already paid taxes at the entry. So we receive our income, we pay taxes on it, then we contribute to a brokerage account. We're going to pay taxes on capital gains that we have on this account, as well as dividends. So really, that's a great bucket, this one, for liquidity, because you can access this money at any time. And but it has a price, because you get basically taxed up to 3 times. And the third bucket is this one is the after-tax tax never. So that means we contribute to this bucket by putting money after, just like the second one, after we pay taxes, and the money will grow basically tax-free. So that's a great bucket to invest for long-term investment. So if we look at, for example, a Roth option, that could be a Roth IRA, or even some folks have a Roth option inside of the 401k. A 529, so that's a way to contribute for college education for kids. Basically, you can start by putting $1,000 a month into this account, into different stocks, ETFs, bonds, and the money will grow tax-free. So that's a great way to invest for kids, as well as municipal bonds and specifically design life insurance products. This is a great opportunity, this one, if you want to contribute to this bucket, but you're basically over the salary limit to contribute to a Roth account, which is about 200K right now. So that could be a good alternative. So what we've been doing for some folks with Jonathan is to diversify the way we contribute to each of these buckets, so that when going into retirement, we will pay less taxes. So just to give you an illustration, so let's say all your money you're saving all your money in retirement into a 401k. If going into the retirement, you're looking to live off about $100,000 a year, you will need, in order to have this lifestyle of $100,000 a year, if you pull out the money 100% from this first bucket, you will need to withdraw about 125, simply because you pay taxes on it. So depending on your tax bracket, it's probably around 20-22%. So you will have to pay $25,000 a year in taxes. Whereas if putting a strategy in plan in place by diversifying. So we put, instead of pulling 100K from this bucket, we pull out maybe 50 and 50 from this one. So from this bucket, we'll not pay any taxes. And from this one, instead of paying 25 to withdraw 50, we'll basically pay about we will withdraw about 60,000, which is 10,000 a year in taxes instead of withdrawing 25. So that's one of the ways to look at saving efficiently from a tax perspective in the US. That's basically it in terms of taxes. The other points that we wanted to mention here is around retirement. So do you want to take that part, Jonathan? I don't know if you can annotate, but.
Oh yeah, I can annotate. What I like about what Sebastian just showed is that if you add that up, so you're showing like $15,000 of tax savings every year in retirement if you diversify. Let's say you have a 30-year retirement, right, that you're planning for. That's $450,000 in taxes saved over retirement. It's almost $500,000 that would be not in your hands otherwise, but if you plan properly, it can go to you instead of to Uncle Sam, right? So does anyone have any questions on the tax piece before moving on? Right. So we did want to show you really briefly kind of where retirement planning fits in for people, because there's people of all different ages, you know, on this call, and we work with people around this who are in their 20s and 30s, and then work with people on this who are in their 60s and 70s, anywhere in between. So the key is tailoring to you what you actually want, right, and creating a plan based off of your goals. Now, there's two phases to retirement planning. So Sebastian and I want to simplify it because this could speak to a number of different people here. That applies to something called a sequence of returns, retirement strategies. You may or may not have ever heard of this. So if you go down to that one, Sebastian, thank you. So a sequence of returns, and I can try to annotate here. You see that all right? Okay. So basically what it says is that there's two phases. There's this accumulation phase, right? And then there's a distribution phase. Now in the accumulation phase, there's only a couple things that matter, right? You could have a portfolio that is starting off really strong. So portfolio A has 22% the first year, then 15, then 12, right? It's growing. And then it starts to go down, right? You have a bad year, and then another bad year, and you average 7%, right? Or you could have a 7% average across the entire life, and you end up with 7%. Or you could reverse the returns and have negative returns at the beginning and positive at the end, right? What the accumulation sequence shows us is that it doesn't really matter in what order you get your returns. What the only thing that matters is max amount of investment returns so that your money grows, and the amount of money that you save, right? So the amount of money you save and then the return that you get on average. Because as you can see from all three portfolios, you end up at the same dollar figure, right? Now that's stage one. So maximizing the amount that we grow and the amount that we save is the important part over time. Contrast this to the second part of the sequence of returns. So if you go to the distribution, right, if I clear my annotation here, right, same portfolios, one good at the beginning and then bad at the end, one average throughout, and then one that reverses and is lower at the beginning, and then you get your good returns later. They all average the same thing, but the portfolios are completely different. In one scenario, portfolio C, you run out of money before the end of your plan. You're planning for into your 90s, right? Preferably. And your funds run out before your 90s. Portfolio B, you're starting to cut it close, right? Because you started with $1 million you're now down to 0.4. Portfolio A, you start with $1 million, you end up with more than you left off. So what happened? So what happened here is the sequence in which you had these returns during the distribution phase. So the second phase, where you're now taking the money out and you're not necessarily putting money in, does have an extreme effect on how much money you're going to have over the long run. So why this matters for people who are still in the accumulation phase is you can actually protect against future distribution risk in the way that you're investing today. So you can invest in investments that provide you hedges against downside risk, right? So that you avoid portfolio C. You can invest in funds that are going to generate you income, right? Whether it's dividends, real estate investment trusts, interest, right? So income that's going to be produced for you in retirement that can help offset these distribution risks. Because there's one thing we cannot control, and that is what the markets in the US and elsewhere are going to do day to day, but we can control the variables, how we plan for it, how we choose to invest in those markets, and how we choose to protect and grow inside of these. All right, so if you combine tax savings with a sequence of returns plan, you're already off to a hot start. All right, this is what we help implement for people. Right. So from there, the last part, and the part that most people are most interested in, is what do we do about the markets these days? What's in California right now, I'm sure, Patricia, near where you are, there's a lot of even more talking than there probably is on the news over here, which is already a lot about everything going on with the banks, right? Everything going on over the last 15 years in the US market. This is the first time that this event has occurred, right? Where the last 15 years, if you really look at it, if you take COVID out of the equation, right, where we had a dip in 2020 and then we kind of bounced right back. If you take that out of the equation, we've had pretty much 15 years of smooth sailing, right? The markets are essentially going up if you look at it on an average as things go up and down. That's a really, really good time, a really, really good time frame. And it's become so long that people have maybe forgotten what it's like to invest in a different time frame, which may be very, very well what's we are going to encounter, which is that it's not necessarily the same. We may have years, multiple years of up and down, right, in the future, as is the rest of history. Right, the last 15 years has been quite nice. So when we look at the markets, we'll give you guys a couple of takeaways. So number one, when we look at the way that portfolios are built, and so I'll just draw this out, Sebastian, if you can see this okay. Probably change my color here, maybe not. So there are three main sections in the market. So there's the US positions, right? They make up about 60% of the whole world market capitalization is based in the US, right? Part of the rest comes from what we would call here international positions, so other pieces of the world market, right, beyond the US, and then also bonds or conservative money, right? So these three positions are primarily make up an investment portfolio. So if you have a 401k today, right, it's going to be more than likely, if they set it up for you, it's going to have a piece of each of these. If you have an IRA today, or if you have a brokerage account, right, these are the default recommendations that are given to us. Now, if we give you a quick history lesson, take you back to the 1950s, we can determine where this all came from. Right, so this idea of breaking apart into three parts was actually made back in the 1950s by something called modern portfolio theory. You can look this up. So Harry Markowitz, back in the 1950s, made this concept called modern portfolio theory, and it worked really well back then. But the problem is that the world's changed a lot in the last 70 years, right? So this is a piece that now we are helping educate, people on who are, have been doing things the same way for decades and decades and decades, and it's a different world today. So if you look up what updated theories there are now, one of those is something called Yale endowment theory. So instead of modern portfolio theory, what Yale endowment theory says is we shouldn't necessarily just invest in the US, international, and bonds, right? What we need to do is we need to diversify outside of these traditional positions. The reason why is if you look at Yale Endowment Fund, which has become very famous over the last couple of decades for how well they've performed, is that they're realizing that the markets are tied. I'll delete this here. The markets are tied together, US and international, and bonds are a not as efficient asset, especially due to their interest rate risk. So we'll get into this, show you what I mean. So first, Yale endowment theory talks about US versus international. So if we take a look at the last 25 years of the markets, right, first thing we'll see is this gray line, which represents the S&P 500. It's the top 500 companies in the US. And then you'll see this purple line, which is the all country world index, excluding the US. So everybody outside of the US, right? Now, when you're investing in the US, whether it's through an employer, the 401k, or it's through an IRA that's set up, at an institution, they will likely start you off with this kind of breakdown, some in the gray line, some in the purple. Now, what you may notice is over this time frame, 97 to 2022, there are a few trends. Number one is that the way that they move together, right? You see the US goes up, international goes up. US goes down, international goes down. Right? These lines tend to move together. And then about 2012, it gets more spread out, right? You see that, yes, they continue to move in similar directions, but the US tends to outperform the purple line, right? So you see, for one, during COVID, right? So US dropped 34%, international dropped 39%. And then when international rebounded, they rebounded less. So the question is, what's going on, here? So when you're investing in the US, whether it's through your employer or by yourself, the positions that are being chosen are either going to be a high quality market share in the US, such as the S&P 500, which is the 500 top companies in the US, or it's going to be, in the case of the purple line, a very broad index, right? So you're going to have companies in all sorts of different areas, and you can't control that, right? If we could pick certain companies inside the international markets, then we do, right? But when you're talking broad investments, such as mutual funds, ETFs, 401k options that they give you, they're very limiting. So what we find is that you will be in the gap here, right? Missing out on performance that is otherwise not giving you an additional benefit. For example, if you're going to go down 39%, right, then you should go up proportionally more, but yet we don't see that, right? Getting less return on the upside. So when it comes to investing in the US and international markets, we've become very picky. Instead of saying, yeah, let's do it, let's invest in both, very, very broad speaking, right? We, over the last few years, have been stripping out, according to Yale endowment theory, out of the pieces that are broad-based, right? Investing directly in the US, and then in select international companies who are performing very well and that we do like very much. But the reason why is because of the way these companies, these lines move together. When one goes up, the other goes up. One goes down, the other goes down. It's the opposite of the intention that it was originally made for. And back in modern portfolio theory, they were supposed to be opposites, right? A yin and a yang, or a zig and a zag. Now what do we see? A zig and a zig, right? It moves together. And it makes sense, we're looking at 97 to 2022. What happened during this time frame? We had the internet, we have globalization. If I drew this back out to the 50s, it would work, right? If I drew this back to the 50s, when international did this, the US would do this, and vice versa. You would see some kind of diversification. You could get right in the middle and make your returns more efficient. Today, it's not the case. Right. This is a huge opportunity for folks, especially as the trend continues over the next few years. There's nothing indicating this trend will change and suddenly swap as of today. So this is kind of the part one of how to approach the markets from a big standpoint. Now, if we want to approach the markets mainly from a US heavy position, especially if we're investing in the US and this is the options that are given to us, the question becomes, how do we want to actually do that? Right. So Sebastian, if you want to go down to the equity markets. Okay. So back in 2021, this was one of those great years. This is the ones we look back on and we miss it, right? End of 2021, you had some very, very nice returns. If you look to the middle of the screen here, there's really 9 boxes when it comes to the US market. There's this value box, there's a growth box, and there's a blend of the two. And then there's the small companies, the medium companies, and the large companies. This is called fundamental analysis. So a fundamental analysis, you have a 9-box strategy. Growth companies are companies like Tesla, Netflix, Google. Right? They invest in research and development and they want to grow very fast. Value companies are more like Coca-Cola, Johnson & Johnson. Warren Buffett would invest in these kind of companies. And so they're more interested in dividends and having a large balance sheet, lots of cash on hand. Right? 2021, they were all doing pretty well. Right? Almost every sector was performing very, very nicely. But there was some things on the horizon. Right? So the way you do that in fundamental analysis and the way that we approach the markets is, if you look to the bottom right, observing the PE ratios. So a PE ratio is the price of a specific group of stocks or stock over the earnings that it actually has. So if you're well above 100% against your average that you're normally at over the last 20 years, then you're pretty overvalued, right? Your price is pretty inflated for the amount of earnings you actually have. And if you look at the end of 2021, where almost every piece of the market was over 100%, especially the growth side, especially this growth side. So what we were doing is shifting and saying, let's get away from some of this riskier, very overvalued growth side. So you can see what happens in 2022. We started shifting away from growth to value. So 2022 rolls around, right? And there's our nice negative numbers, the ones that are never fun for financial advisors. All right, where growth especially got hammered compared to value, right? The difference of 27.9 and 8.5 in a portfolio, if you had $1 million, is a $200,000 loss, right? So switching, and what we've been doing heading into 2022 is shifting and protecting the portfolios out of growth into value and maintain that throughout 2022. And this is where we're looking again today, right? As we approach 2023, looking at some of the PE ratios, where is overvalued? What are we still waiting on? I mean, Sebastian, I think you have an updated 2023 one as well. You can show people where it's at, right? So year to date, it's an interesting start, right? We've got some positive pieces on the growth side here. We've got value being a little more negative to start the year, but the PE ratios never lie, right? The growth side is overvalued still. So if anyone has gotten caught up in, the tech, bubble's coming back, the growth side is doing okay, the risk is there, right? We're still overvalued on the growth side, and it's just now starting to get more reasonable when it comes to the value side, as is shown, in part by the recent bank run that we're experiencing. That was especially, with the thing Silicon Valley Bank invested in the growth side. It had some crypto ties, and it made it a little bit more risky, but it also was not very well diversified amongst its clients. It was very heavy on this growth side, very, very heavy. So with it being overvalued, that led to, in part, some of the issues they experienced. Right. So fundamentally, now we're throwing a lot of numbers at you, but this is how it goes, and it can be proactively attacked as a plan, with the investments. Okay. So that's equity markets. Equity markets. Now the last piece here, and the last thing I'll show you folks, is if this is the aggressive stuff, right? This is the stocks, this is the equities. What's going on with the more conservative piece? So back in the day, what we were told to do was invest in bonds, and you could retire back in the 80s just on bonds. It's pretty great. Nowadays, it's a little bit different. So there's a relation between bonds and interest rates, which bonds are just supposed to be the safe stuff, right? More stable. Bonds, when interest rates go down, bonds go up, and vice versa. So with the recent news, it is very likely that we will continue to experience high interest rates or in a continual rise of interest rates, which means that the opposite is true. If interest rates continue to rise, bonds will fall in value. I think we could show you exactly what they've been doing as of late. So looking at the federal fund, there it is. So federal funds rate here today is at 4.63. We've been rising all year. So any positions that have been in bonds have been suffering, but they will continue to rise for a time. And as they do, any bonds that we hold actually will lose value. It is an inverse relationship, but not forever, right? There is a day when rates will come back down. Mortgages will not be quite as high of an interest rate. And at that time, we need to be proactive to take advantage of that in our accounts too. We can buy bonds that will get us significant upside, just as they have suffered significant downside. Right. To give you a point of illustration of how much downside, Sebastian, can you show the next slide?
Yeah, that was 2022.
Yeah, 2022. If you look here at what bonds did, it's almost astonishing what the safe side of the market suffered. Right, they had -28, -14, -10, just depending on what you were invested in bonds. Some of the safe things. So in summary, you look at that whole portfolio, right? US, international, and bonds. Last year was the perfect example. US lost money, well, so did the international, right? When both of those positions lost money because of rising interest rates, then bonds also lost money. So when people are afraid of the markets right now, it's not without good reason, because it appears that traditionally all of the different kinds of investments are working no longer to help diversify from each other, but altogether to take losses. So if we see the next few years being this choppy up and down, that it very well can be, we want to maintain a investment in these core traditional positions for sure, but we can be smart about it, right? We don't have to expose ourselves to excess lack of diversification, such as the tie between US and international. We don't have to expose ourselves to bonds that are continuing to lose to interest rates. right? There are alternatives for these things, which is what we're working on, with our clients here today. Under the principles of the Yale endowment theory, right? So that's the main pieces. Sebastian, I don't know if you had anything to add to that specifically.
No, that was basically it. I mean, in terms of the bonds, we see the same trend in the beginning of the year so far, simply because the Fed has been rising interest rates, and with the inflation coming this morning, they're probably going to do it again. So that's the same trend, but yeah. But it's basically all we wanted to show you guys today. So now if you have any questions, just
we have a few minutes. So if you had questions, drop them in the chat, or don't be afraid to unmute. Sebastian doesn't bite too hard.
No.
Yeah, actually, I had a question. Thanks a lot for the presentation. So you were saying that so the PE analysis tell you if some stocks are over-evaluated, right? And then if it's the case, you should like protect the portfolio and move away from it. That the other way around works. Like if it's under-evaluated, does it mean that you should invest in it? Or does it mean that the company is just doing bad and just also go away from it?
Great question. So it does mean that it could be an opportunity. So if you are seeing something that has better earnings than is reflected in the price, so therefore it would have a lower price to earnings compared to its 20-year average, then it certainly could be an area to invest in, such as, for example, if small cap value here is lower than its 20-year average. So in terms of a long-term investment, that could get you more upside than, say, a large cap growth, at least for the next a little while.
Okay, and thanks. And is there like other important to take into consideration? So we can look at that PE indicator, but is there any other approach that we can do, like to have a strategy about investing?
Yeah, so it depends on if you're picking individual stocks or you're looking at retirement type of accounts, mutual funds. But you can find PE ratios for specific funds like this and specific areas of the market. You can also find them for specific stocks. You could also look at the technical analysis. So this is called fundamental analysis. There's also technical analysis that indicates charting in the areas and direction that the market is going based on patterns. So you could look into technical analysis as well. Fundamental analysis says, what is the cash flow? What is the balance sheets of these companies, right? You can read their annual reports, look at the things like the PE ratios, or you could do technical analysis.
Okay. Thanks.
Good question. Great question.
Any other questions, guys?
I have a question. Could you develop more the top of this triangle, the tax never investment?
Yes. So
because as you explained, the tax is a big impact on the investment. So how do you maximize that top of the?
So basically, there are multiple ways, whether it's through like a retirement account, like I mentioned, like a Roth IRA, or like if you're looking for education planning, that's also something you can do. Let me just find my pen again. But typically, it's a type of Roth account. So I don't know if you heard that before.
Yeah.
you're limited in terms of the money you're making. So if you're making over 200,000, you cannot contribute, but you will not get the tax advantage of contributing pre-tax. So you'll already pay taxes on your income. But what's important, whether it's short-term or long-term growth, if we're looking to invest like a consistent amount and we're looking to grow this money over, for example, 10 years, that's where this bucket is usually very useful. If we're looking for short-term investments, you will not get basically the tax-free benefits as much as for long-term investment. But does that answer your question?
Yeah, what's a SDLI again?
SDLI is specifically designed life insurance. So it's a specific product that would benefit. It's typically like just like a Roth account. We usually compare those. SDLI is actually called the rich man's Roth, because you don't have a minimum a maximum income you need to make in order to invest in it. And you can have multiple type of investment. You can tie it, for example, to an index, so that you grow up with the market and you can still get the tax-free in retirement. As it's a life insurance product as well, you can get you can purchase a death benefit, but it's basically overall what it is. So it can also replace like a 529 instead of investing directly for like an education plan. An SDLI also provides, you can also take out the money on this account to pay for college education, as well as other medical expenses. So that it's a comprehensive life insurance product. I don't know if you heard that before.
I heard about the one you can withdraw the cash life insurance, they call it? Whole
Yes,
life?
Yes, for life insurance, you can have multiple aspects. So you can have the whole life insurance, term life insurance. What we're mostly referring to is index life insurance in that case, because the money will grow on the account. So that's why you enjoy the tax, the tax-free at the end of it. You're basically putting money on this account, for example, every month, and it will grow tax-free and get tied up to an index. So the cash value on the account will grow.
You can withdraw the cash. You don't need to use as a life benefit.
Yes, you can withdraw the cash. Typically, you have, depending when you're withdrawing the cash for, but you get surrender charges, for example, if you withdraw within 7 or 8 years. And so you have to wait at least some years before withdrawing the account. But if it's something that we invest like consistently, like each year, for example, or every month after 7 or 8 years, that's a great investment. Simply because you can also get use the power of the floor strategy, as it's called. So that means that the principal would be protected, meaning you don't suffer like market downturns. The money that you put on the account, the cash value will remain positive, and you will always get the money that you put in. So it's a good investment, especially for right now, with what's happening on the market.
Okay, thank you.
Cool.
Any other questions?
Be a resource. So, I don't know, we were only on the page for a second, but it had our contact information, because we do this on a more customized basis for people that want to develop and work on a financial plan, or at least have a conversation on what that would look like. So I believe Sebastian has a link where someone did want to, sit down for a quick 20, minutes to develop with him a little bit more detail, we're happy to do so, especially for folks like yourselves, wanting to learn, wanting to get ahead and be proactive around your finances. But yeah, it's great to meet you all. Sebastian, I don't know if you had anything else before we let everybody run.
I don't know if it works. I put the link in the chat if you guys are looking for more like 20 or 30 minutes one-on-one, but does anyone have other questions?
Okay, well, thank you very much. Should
Perfect.
you have any question? In one question? I think you can stop the recording, I guess.
Okay.